Hello and welcome to Financial Intelligence. In this video, I want to talk about the hot IPO market. The real question is, who makes money from these hot IPOs? I have decided to focus on CoinBase as an example to demonstrate what happens behind the scenes. CoinBase was one of the most anticipated IPOs of 2021. It is also a great use case that shows clearly how Wall Street bankers utilize the IPO market to make money. This video is divided into three segments. In the first part of this video, I'm going to talk about the parties involved when a private company such as CoinBase goes public. In the second part of the video, I'm going to share with you how investment bankers leverage the financial media to create hype around the IPO to lure in retail investors. In the third part of this video, I'm going to talk about how the wealth transfer from retail investors to Wall Street bankers took place during the IPO of CoinBase. If you like the type of content that I provide on this channel, subscribe to the channel and give this video a thumbs up, and also hit the notification bell so that you don't miss any of my future videos. Part 1. Parties involved in IPOs. An initial public offering, or an IPO for short, refers to the process of offering shares of a private corporation to the public through stock exchanges. In essence, an IPO means that a company's ownership is transitioning from private ownership to public ownership. An IPO can be seen as an exit strategy for the company's founders and early investors. Companies that are planning to go public hire investment banks to facilitate the process. Investment banks make money on IPOs because they're allowed to purchase the company's shares at a discount. Then they can sell these shares to large institutions and brokers at a price level called the initial offering price. These institutions and brokers then turn around and resell those shares to retail investors. As you can see, the company's founders and early investors, Wall Street bankers, and brokers have strong incentives to create an environment where they can extract as much money as possible from the retail investors by creating a hype around IPOs. In the case of CoinBase, it was easy for investment bankers to create the hype because most retail investors were already excited about cryptocurrencies. Part 2. Creating hype around the IPO. In the case of CoinBase, Wall Street created a huge amount of demand by publishing all kinds of articles through their partners in the financial media. Here are some of the headlines that I have picked from the articles written around the day of the IPO, which was on 14th of April 2021. NASDAQ's website. CoinBase IPO exceeds all expectations, showing more promise for Bitcoin. TheStreet.com. CoinBase tops 100 billion on debut. Jim Cramer says it's the real deal. Washington Post says it is more than just Coinbase. Crypto giant snares $85 billion in valuation in NASDAQ debuted. One of the most important aspects of investment bankers' involvement is to market the IPO. The delta between the offer price, the price at which bankers are given the shares, and the open price on the day of the IPO, the price at which bankers get to sell the shares, determines how much money they are going to make. For example, the offer price for CoinBase was $250 per share. The open price on the day of the IPO was $328. This means that the Wall Street gang made at least $78 per share or 31% gains right off the bat from CoinBase's IPO, and that money came from the pockets of retail investors. Now, let's take a look at what happened to those poor retail investors who fell for this propaganda and bought Coinbase during the first few days that it was made available to the public. Part 3. Selling to retail investors. This chart from NASDAQ's website shows the price action of Coinbase a few days after it went public. Note that during that period, investment bankers, brokers, and their clients were busy selling their Coinbase shares. In the meantime, retail investors who were excited by the media hype were busy buying those shares at extremely elevated prices. As you can see, the price started to drop because there was a lot of selling pressure coming from the Wall Street gang who were trying to make as much money as possible before the IPO died down. This is a great example of how the wealth transfer from the retail investors to Wall Street bankers takes place during IPOs. Well, some people might argue that this is an isolated edge case. It is not. This classic pop and drop scenario is followed by nearly every IPO after the internet bubble crash. I hope that you like this video. If you have any recommendation or suggestion, please add them in the comment section below. Don't forget to subscribe, like this video, and also hit the notification bell so that you don't miss any of my future videos. Thank you and take care.